Money. It's the fuel that drives the global economy. But what if I told you that not all of it is clean? Every year, billions of dollars are funneled through the shadows, hidden from the eyes of law enforcement. This dark and secretive process is known as money laundering. But how does it work, and why should you care? Welcome to our channel, where we break down complex financial concepts into easy-to-understand insights. In today's video, we're diving deep into the world of money laundering. By the end of this video, you'll not only understand how it works but also why it's such a crucial issue in our global economy. So, let's get started. First, let's define money laundering. At its core, money laundering is the process of making illegally gained proceeds, dirty money, appear legal or clean. It's a crime that affects economies worldwide, enabling everything from organized crime to terrorism. But how exactly does it work? To understand, we need to break down the three critical stages of money laundering. The first stage is placement. This is where the illicit money enters the financial system. Criminals might deposit large sums of cash into banks, buy high-value items like real estate or luxury cars, or even gamble it away in casinos. The key here is to get the money into a legitimate financial institution, making it easier to manipulate. But how do they manage to do this without raising suspicion? One common method is called smurfing. In this technique, the launderer breaks down large sums of money into smaller, less noticeable amounts and deposits them into various bank accounts. This way, the deposits remain under the radar, avoiding the automatic alerts that banks are required to trigger for large transactions. Next, we have layering. This is the most complex and intricate stage. The goal is to create a complicated web of financial transactions that make it difficult to trace the original source of the money. Criminals might move the money through various bank accounts, shell companies, or offshore accounts. They could convert it into different currencies or invest it in stocks, bonds, or other assets. The more layers, the harder it becomes for authorities to track the money. One famous example of layering involves the use of offshore banking havens like the Cayman Islands or Switzerland. In these jurisdictions, secrecy laws protect the identity of account holders, making it nearly impossible for law enforcement to follow the money trail. The money can be shifted between multiple accounts and countries in seconds, creating a labyrinth of transactions that obscure its origin. Another technique is to use complex financial instruments such as derivatives, which are harder to value and track. By investing in these, the launderer not only hides the money but might also make it grow, increasing their profits while further distancing the funds from their illicit origins. Finally, we have integration. This is where the clean money re-enters the economy, often through legitimate businesses or investments. At this stage, the money is so well hidden that it appears completely legal. Criminals might invest in real estate, fund new businesses, or purchase luxury items. By this point, the money is nearly impossible to distinguish from legally obtained funds. One method used in integration is setting up a front company, a legitimate business that operates as a cover for laundering money. This could be anything from a restaurant to a car dealership. The criminal injects the clean money into the business, mixing it with legitimate revenue. Since the company appears to be making profits through regular business operations, the illicit origin of the funds is concealed. Another tactic is to invest in businesses that deal heavily in cash, such as bars, casinos, or laundromats. These businesses naturally handle large amounts of cash, making it easier to introduce laundered money into their revenue streams without raising suspicion. So, how do criminals actually pull this off? Let's look at some of the most common techniques used in money laundering. One of the most popular methods is real estate laundering. Criminals purchase property using illicit funds, then sell it, often at an inflated price, to clean the money. Real estate is especially attractive because it holds value and can be sold multiple times to further obscure the money's origins. Take, for example, the case of the Russian laundromat, a scheme that involved the purchase of luxury apartments and properties in prime locations across Europe. These properties were bought using illicit funds and then resold at a profit. The proceeds from these sales appeared clean because they came from legitimate real estate transactions. Another method is the use of shell companies, businesses that exist only on paper. These companies can be used to move money around without drawing attention. They often operate in jurisdictions with lax financial regulations, making it easier to hide the true ownership and origins of the money. For instance, during the investigation into the Panama Papers, it was revealed that numerous world leaders, celebrities, and business tycoons used shell companies to hide their wealth and launder money. These companies were set up in offshore jurisdictions with minimal oversight, allowing their owners to conceal their identities and the origins of their money. Trade-based money laundering is another sophisticated technique. Criminals manipulate the value of goods and services in international trade, using over or under invoicing, or shipping goods multiple times to move money across borders. This method is particularly challenging to detect because it involves legitimate trade activities. An infamous example of this is the black market peso exchange, where Colombian drug cartels laundered billions by exploiting trade deals. They would over or under invoice goods exported from Colombia to the United States, disguising the illicit funds as legitimate revenue from international trade. With the rise of the digital economy, online money laundering has become increasingly common. This can involve using online payment systems, cryptocurrencies, or even online gaming platforms to move and obscure money. The anonymity and global reach of the internet make it a powerful tool for money launderers. In recent years, the popularity of cryptocurrencies like Bitcoin has provided a new avenue for laundering money. Cryptocurrencies allow users to move large amounts of money across borders with little oversight, thanks to their decentralized nature. Criminals can convert their dirty money into cryptocurrency, transfer it through a series of anonymous accounts, and then convert it back into traditional currency. This process makes it incredibly difficult for authorities to trace the original source of the funds. But why should we care about money laundering? Its impact goes far beyond the financial world. Money laundering has serious consequences for economies and societies. It undermines the integrity of financial systems, contributes to corruption and inequality, and funds criminal activities like drug trafficking, terrorism, and human trafficking. When laundered money flows freely, it distorts markets, inflates real estate prices, and weakens the rule of law. For example, in countries where money laundering is rampant, the influx of illicit funds can drive up real estate prices, making housing unaffordable for the average citizen. This was seen in cities like London and Vancouver, where money from corrupt officials and organized crime groups was funneled into luxury real estate, pushing prices beyond the reach of local residents. Furthermore, money laundering can exacerbate income inequality. The vast sums of money moved by criminals often escape taxation, reducing government revenue and leaving less money for public services. Meanwhile, legitimate businesses struggle to compete with those funded by laundered money, leading to economic distortions and a loss of trust in the financial system. Let's look at some real-world examples. The Panama Papers, for instance, exposed a global network of offshore accounts and shell companies used to hide wealth and launder money. The leak of over 11 million documents revealed how politicians, celebrities, and business leaders were using these structures to avoid taxes and hide illicit funds. This scandal not only shook the financial world but also led to increased scrutiny and tighter regulations on offshore banking. Another infamous case involved HSBC, one of the world's largest banks, which was fined billions of dollars for facilitating money laundering by drug cartels. An investigation revealed that HSBC had allowed these cartels to launder money through its accounts, failing to implement adequate anti-money laundering controls. The scandal highlighted the critical role that banks play in either enabling or preventing money laundering, and it led to significant changes in how financial institutions monitor transactions. So, what are governments and institutions doing to combat money laundering? Money laundering is a complex and global issue that affects us all, whether we realize it or not. Understanding how it works is the first step in recognizing its impact on our world. If you found this video informative, make sure to give it a thumbs up and share it with others who might benefit from this knowledge. Don't forget to subscribe to our channel for more deep dives into the financial world, and check out our other videos to learn more about the topics that shape our economy. Thanks for watching, and we'll see you in the next one.